First of all, hello, everyone. Thanks to Tanya. She's got so much experience, and I am happy to be able to work with her and many other qualified, really experienced retirement plan consultants. Makes my job a little easier. And first, I just want to collectively give ourselves a pat on the back for getting through the majority of 2020. It's certainly been a roller coaster of a year. There have been ups and downs and struggles, I'm sure, for all of us, both personally and in the workplace and in your offices. But we're going to get through it and we're going to come out on top. One thing the 2020 probably has taught us is to identify our strengths, what's really important, how we can be more resilient going forward. And I'm sure along those lines, some of you who may be employers or business owners might be thinking a little bit more this year than any other year about mergers and acquisitions. And I know, of course, that, if you're thinking about a merger or an acquisition, I'm sure that the retirement plans are not at the top of your priority list. But I want to just take this time to go over some issues that might come up and then hopefully stress to you the importance of the timing and also talking to your retirement plan consultant. So for today, I'm just going to go over the types of transactions. So there's 3 separate types. And there's lots of different complications, but they all kind of fall into one of those 3 categories. And then, of course, the biggest question I think a lot of employers have is, how do we credit service when it comes to these types of transactions? Who gets credit for working and for what company, and how do we get through those requirements on the retirement plans? And then I'll go through some really simple examples just to kind of show you how it works in terms of real life transactions. Of course, no real life is going to be as simple as I'll show you, but it'll just be some examples. And then I'll finish up with some key takeaways for everyone today. Okay, so like I said, there are 3 categories of transactions. There's an asset sale, a stock purchase, or a merger. So the asset sale is that the selling company sells some or all of its stuff to the buyer. This can be a book of business, an office, or a certain division of the company. And the main point here is that the seller is maintaining their current ownership structure of the business. And they're just selling off a portion or all of the stuff, the assets. Next category would be a stock purchase. This one is different because the selling company changes its ownership structure. So this comes into play in terms of how you treat the employees, and we'll go through that as well. And then a merger would be 2 companies combined to make one company. So it can be company A and company B come together and they create company C, or maybe company A and company B come together and they decide to be company A as the surviving company. This company A, or the new company, now owns all that the previous companies owned before. And this includes the retirement plans and the plan sponsorship of those plans. So the key takeaway here really today is that timing is everything when you're talking about mergers and acquisitions. It's a lot easier to deal with anything that might come up prior to the close of the transaction as opposed to afterwards. And then afterwards, it's kind of more of a cleanup issue as opposed to a proactive approach. So I just want to remind you that please communicate with your retirement plan consultant if you're thinking about something like this, or if you feel like it might come up in the future. And then that way we can help you address anything and make sure that there's a smooth transition going forward. Okay, so going through some service crediting rules, as I said, it depends on the type of transaction. So with an asset sale, the employees of the seller, as part of, say, they're selling a division, those employees will now be terminated employees of the selling company on that date. They will become new employees to the buyer as of the date of that transaction. So they're eligible to take distributions, whether it be a rollover into an IRA or a lump sum cash distribution, just like any other terminated employee from the seller's plan. As new employees to the buyer, they now are subject to the eligibility requirements for the buyer's plan. Now, the buyer can choose to amend the plan to give credit for the service that those employees have worked for the seller. That's an option, but it's not a requirement. And then this service can be credited for eligibility or vesting, and also any contribution allocations as well, if that's service related. For a stock purchase, employees are typically treated as employees with continued service from the seller to the buyer. Now, this isn't always the case. It's not set in stone, but this is typically what happens. What happens with the seller's retirement plan is up to the buyer when doing a stock purchase. Some options, they could terminate the seller's plan. And then when you terminate the seller's plan, you're not giving the employees any option to take a distribution at that time. You're just moving the plan assets from the seller's plan into the buyer's plan. You could merge the seller's plan into the buyer's plan, which I think is probably pretty typical, what usually happens. I'm sorry. So when you're terminating the seller's plan, you are giving the employees the option to take a distribution. You're terminating the plan, so they will be able to do what they want with their account balances in a plan termination. In a merge is where the employees are they do not have the flexibility of taking a distribution. We're just merging the seller's assets into, or the seller's plan assets into the buyer's plan. Now, there are some cases where you can keep both plans, having each company maintain their own plans, but that's not really typical. It doesn't really happen due to the demographics. And also when the transaction happens, you're becoming a controlled group. So you're kind of bringing in those regulations. And so it's usually more costly. And so it doesn't typically make sense to keep both, but it is an option. So there's also a merger. So here the merger, it's pretty similar to a stock purchase. The surviving company does become responsible for all plans sponsored or adopted by either company before the transaction. So they're responsible. They do have those options. They can terminate, they can merge the prior plans and make a new plan, or they can keep both as well. So you kind of have those options as a merger. Same as in a stock purchase. The employees are generally considered to have the continued service, so their date of hire would stay the date of hire of the original company that they were working with. And so you don't really have the eligibility issues or questions that come up with a merger. And then, so you just have to remember here that the surviving company does have to decide what to do with all of the plans. So I'm going to go through just some simple examples. Of course, real life, nothing's going to be this easy, but for a simple example of an asset sale. So say we have Salt and Spice and they're doing pretty well, except there's one part of their business that maybe isn't part of the core process, and maybe they've decided to sell it off. And they've decided to sell their sugar division to Sweets Galore on September 30th of 2020. So what's happening here is Salt and Spice Co. is maintaining their current ownership structure that's not changing. All that they're doing is getting rid of that sugar division. So the employees are terminated from Salt and Spice, and their first day of employment by Sweets Galore is on September 30th of 2020. So Sweets Galore, like we said, they can amend their plan to allow for crediting of service to those sugar employees the years that they worked at Salt and Spice. They can add that in and and count that service towards their eligibility, or they don't have to. So some considerations for Salt and Spice Co., and this is kind of where it's important to talk with your retirement plan consultant is, of course, these employees are now terminated. The question is that division large enough to constitute a partial plan termination? And typically, a partial plan termination is when at least 20% of your employees are terminated at the same time or for the same reason. And so if the sugar division is big enough, then all of those sugar division employees would then be 100% vested in their account balances with the Salt and Spice Co. retirement plan. So we want to just make sure, we want to avoid that if that's an issue. And so really your retirement plan consultant would help you there. The Suites Galore has simply hired a group of new employees, like again, so they can amend their plan to allow for the service, or they can have the option of making those employees wait the eligibility period as well. And here's an example of a very simple stock purchase. So Bert Inc. buys 100% of the stock of Ernie Inc. on October 1st of 2020. Bert has a 401k plan with quarterly entry dates, and Ernie has a 401k plan with monthly entry dates. So now, as of October 1st of 2020, Bert Inc. has two plans to deal with. And so what happens if these two plans are not modified? We have to look, as your consultant will take a look at each of the plan provisions for each plan. We'll look at the eligibility. It could possibly be the case that you're going to have all employees eligible for both plans, which typically you don't want to have that happen. So that's why we want to get in front of the transaction before it happens, to make sure that the transition is smooth and the testing is done properly. There is a transition period that we can add, and we can amend each plan to include this period, but it has to be done prior to the transaction again. So timing is important here. So say Bert's Inc. Plan, we've looked at it and we see that it excludes acquired employees during this transition period. The transition period actually is fairly generous, I think. So if the transaction happens in 2020, you have until the end of the plan year following, to get those employees into the plan of the buyer's plan. And so, in this example, if it happened on October 1st of 2020, we have until December 31st of 2021 to integrate all of our employees into the payroll, onto the record keeper, maybe have the employee investment advice sessions. You do have some time. So if both documents have this transition period, it makes the merger or acquisition flow much easier. Definitely better for all of the employees. It kind of gives you a little bit of a break there. Again, Bert can count all the service with the Ernie Inc. employees, or it can just count the service once the group becomes a controlled group, which would be on the date of the transaction. So that's 10/1 of 2020. And then the transaction period, again, it just gives you wiggle room. It gives you some time to take a breath. I know there's a lot going on in a merger or an acquisition. There's deciding which employees go where and what happens. So these periods really do give you some time, but we just need to do that prior to that close of the transaction. So, oops, gonna go back here. Some key takeaways. Again, I know I've said it a lot, but we want to make sure that the plan provisions, that we know them before the transaction closes. So the document planning is really important here. And that's why, we really want you to lean on your retirement plan consultant so that we can actually help you and consult you through the process, and really just make it a lot easier for everybody involved. Because again, if we wait until after, which is typically what happens, we usually get notified, maybe a month or so after the sale, and it's kind of more of a cleanup mission as opposed to being proactive. So again, talk to your retirement plan consultant and we'll be able to walk you through. So with that, does anyone have any questions?
Yes, I have some questions, Haley. Once
Absolutely.
again, for those who are on the call, if you do have a question for Haley as well, be sure to use the Q&A tab at the bottom of your screen and submit your question and we'll ask her. In the meantime, Haley, I'm wondering about a company that maybe they bought another company about 3 years ago and they just left the plans all together, or I'm sorry, left them separate. What do they need to do now if they bought the company 3 years ago and they left the plans separate?
Yes. Well, hopefully they still have the plan documents for all three plans. We'd need to get a hold of those. We'd take a really good look at each of the provisions in each of the plans. And we'd have to look at the eligibility, who's eligible for what plan on what date. We'd probably have to go back and do some additional testing that would be required to make sure that everything, it's non-discriminatory and kept up with regulations. It would probably require a VCP filing. Probably some corrections might have to be made depending on the different, if there were different employer contributions to each plan as well. So it kind of really does depend on the provisions of each of those individual documents.
Yeah, so some cleanup, which is why you're advocating for, if you're thinking about a merger or acquisition, call us early, right?
Absolutely.
Absolutely, yeah. Here's another question that came in. How much time does the IRS give to transition a plan when a company is sold?
So that would be that transition period that we talked about. It does have to be in the plan document as a provision prior to the transaction. So the period would be, you have until the plan year, the end of the plan year following the plan year in which the transaction occurred. So you have, if the transaction occurs in 2020, you have until 12/31 of 2021 to make that transition and to allow all of those, incorporate all of those newly acquired employees into the current plan.
Okay, so we got some time. Here's a question that came in from one of our participants. Does Definity help address the control group issues in an M&A?
Yes, absolutely. Of course, the key here again is, the more time we have prior to the sale, the more you will be able to help. But we do take into account all of the ownership. We'll ask you for percentages. We'll also probably ask you for any family relationships as well. That would be employees of each of the companies, and we will do an analysis for you and cover what would be a controlled group and how that would affect you if it does, which it most likely will.
Mm-hmm. Yeah, I'm also wondering if we could go back and just recap what happens in a situation when you have a merger, because you talked about there were situations and they were similar to a stock purchase. You could do a couple of different options, and I just kind of wanted to make sure that that was clear. So like, for instance, when you have a merger, which retirement plan survives?
So it would depend on the company. So if you have company A and company B and they've come together and they've decided that company A will be the surviving company, that company A 401k plan will be the surviving plan document. You can change it, make amendments if you like the other plan better. We could just change the provisions to match the other plan. And so really, it's mostly up to the ownership of the surviving company on what they want to do and how they want to handle that, but it technically is the surviving company's plan that would be the surviving plan.